Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Monday, April 18th, 2022. Hope everybody enjoyed a nice long weekend. At least that's those of you that took Friday off. Markets were closed, of course. That's why I didn't do any updates. Good Friday. But we're back in business today, and let's take a look at the charts. Here's what I'll go through: just an update on the Nasdaq 100 as well as the S&P 500 and Russell 2000 small caps. So we'll cover the major stock indexes briefly from both the long and short-term perspective, and then just updates. I just want to kind of continue to update the things I've been highlighting recently: bonds, the brokers, broker-dealer stocks, as well as the financials, home builders, semis, and crude oil. That's most, not everything, but most of what I was covering lately to really trade or have a broad-based portfolio, a lot of asset allocation. You've got individual stocks, you've got treasury bonds, or stocks, bonds, and the commodities all in that mix. So I'll just go ahead in that order, and we'll start out here with QQQ, big picture. Let's roll all the way back here to the primary uptrend lines, 2009 lows in the market, and really '08 was when the Nasdaq 100 bottomed everything else. So I have dual trend lines, but they both come in together, and those still maintain. I still maintain and have for many, many months now that those are my longer term targets. And from a big picture perspective, not only has nothing changed recently, but more so we've had some kind of encouraging or confirming, I should say, evidence that those targets may be hit. And what I'm referring to there is, we had all the sell signals back here, early sell signals. That was 1, 2, and then multiple bounce backs there. Then the breakdown there, that was big. Then we went down, hit my first target on the weekly, bounced around a little, and we had this recent test and rejection. So this is what recently the most significant technical event that I would highlight here on the long-term bigger picture is that rejection off the second test. Remember, after we took out the 200 days, we tested it right there, had a rejection, pretty big drop, came close to, but not all the way down to my second target down here. And then most recently, boom, we tested for 2 weeks on many different days. These are weekly candles, and then a rejection. And so that's a check mark, the fact that the rejection so far pretty impulsive. But we won't get our next and final big to me big check mark until we take out those recent lows, and that'll be the next check mark, and that should likely open the door. I think it'll be a very swift move if and when they're taken out down to that second target there around 299 300, and once if and when that is hit, I do believe, based on the fact that we'll have had it'll be clear to the masses the second rejection on the 200 days, and you'll hear more bear speak on TV, and you'll have more people and institutions and individual investors start to come to the realization that, hey, maybe this isn't or that wasn't a great buying up. Maybe it's the start of something more. So we'll see. Again, I'm getting ahead of myself, but what I'm trying to impress upon you is the point that if my second target is hit, unless there's something in the charts that convinces me otherwise, I don't think that's going to be the end of the run. I think it's going to sharply increase the odds at T3 and T4, either those trend lines. We'll see if and when we get down towards that level that those are going to be hit. What do the bulls want to see? Well, the bulls want to see hold of support here. I'm going to get to the short-term charts in a second, and then take out on a solid weekly close, especially two weekly candles above, multiple weekly candles above the 200 days with a simple moving average at the top. That's in the blue line there on this weekly. Excuse me, a little frog in my throat there. On this weekly chart here, it is a 40-week 40 period or 40-week moving average. So those are the big levels to watch. And real quick, let's look at SPY. The S&P 500 did the same thing. First cluster of rejections there, tried to break it, and also very, very big level there, about 451. That was the breakout, which proved to be a false breakout or failed breakout to new highs. Tested it, rejected, tested it again for 3 weeks, rejected, and rejected off the 200s, and also needs to take out that those recent lows there about 415. Now we jump down to the shorter term charts. I gave you some levels to watch today, and I gave you my thoughts. I'm trying to make a point. If I show like this morning, I showed you potential bullish developments, which were the positive and are the positive divergences on the 60-minute charts. And, I have to acknowledge those could certainly play out. That could be the catalyst for a rally to or above, beyond any of these levels here. But I'll share my thoughts and tell you based on everything I just started the video with, i.e., the longer term, bigger picture, and how things are playing out. This is where I choose biases. I choose to ignore. Trading, that's confirmation bias. When you ignore something that doesn't align with your outlook on the market or a stock, and then only gyrate or pay attention to things that confirm it. But there are biases that are needed. If you sit there and just say, oh, well, every time there's a bullish chart setup or a divergent low, I'm going to go long. Again, the long-term charts override what I see on the short-term charts, and it will also be another check mark if all these divergences that are here in place right now in the 60-minute charts of the S&P 500 futures, the ETF we're looking at here, SPY, as well as QQQ. If they fail to play out for a significant rally, significant would be up here at least about that 450-ish level right there on SPY. That would be roughly the measured target there. And if we just peter out and take out those the lows, and then more so take out these divergences by making a lower low, taking out these previous lows and the indicators, then that to me is indicative of early stage bear market action. In a bull market, and I've seen this for the last couple of years, I've seen for the last 10, 15 years, you get these 60-minute divergent lows, and that is almost always the catalyst, and almost always has been the catalyst for the start of the rally to the next new highs in the market. And so as we start to see, we had a big divergent low there recently. If these start to fail to play out, so far we had a breakout, but they faded that whole breakout. That's that big 60-minute downtrend line and bullish falling wedge on SPY. You get the same thing on QQQ right there. You had the big bullish divergence downtrend line breakout, but they faded all of that now. And we have the next divergent low right here, just as we did here. So this is what and I'm using little parenthesis signs on my fingers now, quote unquote, the bull what should happen if we're in a bull market, if the stock market's headed to new highs and we're still in a primary bull market with a lot more life left in it, meaning we're going to go back and take out the highs from last year, then this should happen and beyond. However, if this is just a bear market, or if this was a bear market rally, and then this is likely the next beginning of the next leg down, watch for a break of that 335 level. Even if we get a little bounce up here, as long as it doesn't take out this previous reaction high, that's it. So we could bounce, divergences could play out somewhat, but as long as they don't play out for a move to new highs, especially take out, that's a big, here, I'm going to color that up right now. If you want big levels, if you're not a very active trader, but you want to set some price alerts on levels that really should not at this point in time be violated, it's that. Because if we take that out, that number I just put up there is about 370.94. If we take that level out, you're also going to have taken out on the daily chart the 200-day moving averages and a major reaction high right there. So that's a big level to watch right there on QQQ. So this is what I favor. I favor these divergences just being bull food for a bull trap, that is, and bulls buying those divergences, buying the breakout right there so far, which has failed, and then this. And that's going to take us down to my next target there, 318, and then those are your recent lows. That's a big, big, big level right there to me, about 318. You can set a price alert. You're at work, somewhere else, on vacation, and you get a price alert that 318 went, then you're probably going to see a pretty big drop in the market from there. And I told you I would cover the small caps, really just big picture stuff. Big picture says this is IWM, the Russell 2000 small cap ETF. You had this year-long trading range right there. You had one failed breakout attempt, aka bull trap. It was a divergent high, sent us back to the bottom of the channel, broke down, hit my first price target on the weekly chart here, bounced back, and we've been in, you zoom in nice and tight, and we've been in this triangle. I'm sorry, not triangle, the sideways price channel trading pattern there, bouncing around like a game of ping pong between 209 ish and 192 ish right there. So we need to break 192, have some spike lows right there. If you want to put a BOD number, benefit of the doubt, it would be right at the bottom of these two weekly candles there, and that was about 188. So to be safe, 188, but I do believe if we start getting down here and even probably take out that 192, that should do the trick. Open the door to my second target on the weekly chart, 171, and then I have potential third and fourth targets that will likely be hit as well. Okay, Treasury bonds, I won't go into detail. Skip the ETFs since I'm just trying to do quick updates on a lot of things I've covered recently. Of course, you can go back in, check the, at the bottom of this post, you'll see symbol tags. You'll see /ZF, which means the 5-year bond futures. Any futures, I put a forward slash in front of for the symbol, and that's ZF, the 5-year, which is where my sweet spot is. That's where I see the best opportunities for trading bonds on the shorter end of the yield curve now. But I'll just do updates there. So there it was, our beautiful bullish falling wedge breakout. Hit our first target, had a pullback as expected. Hit our second target, had a pullback. We hit it twice actually. I'll zoom in nice and tight for you. But so far, here's the update. We're still above. There's the breakout right there. So the breakout's still intact. We made a higher low there so far. So ideally would be to see us come on up here and start to rally. If that happens, it's probably going to coincide. If these targets are hit and hit soon, it will most likely coincide with a breakdown of the support levels I just showed you on the 60-minute charts of the indexes. If we happen to make a marginal new low, I'll tell you this right now, there's still plenty of room to do so, as long as it's marginal, not too big of a low, to still have positive divergence in place and still go on to hit these targets. So if you're willing to give it room, I showed you long-term trend lines where the yields have hit right now. I think right now, at best, I think Treasuries may be a dead money trade for a little while. Anything is possible. They're certainly in a downtrend or have been, but you can see the momentum is slowing. That's what momentum indicators and divergences indicate. We're heading down impulsively and started going down less and less, and we're really kind of turning here, and that's again showing the momentum shifting and every other reason that I showed you on the Treasury yields and everything to be long bonds, or at least that's what I am now. And it's, not screaming hard buys, but certainly just somewhere I think there's opportunity to make either as a pure play trade or as a hedge to other positions, knowing the relationship between stocks and bonds. And there's ZN, the 10-year, hit that first target, put in a little divergent high, had a pullback, but still maintain these additional targets, maybe all the way up here to that 125 level. Alrighty, that's bonds. Next, I told you I would cover just a quick update on the broker dealers, and that would be, let me just cue this in, any one of them, and it pulls up. You can't see to the right of the screen here. I have a watch list showing all the, this sector is called capital markets on TC2000, and you have, this is a weekly chart, so this is big picture. You have Charles Schwab here, SCHW. There was your rising wedge pattern right there, a breakdown back test, bounce off resistance, and the reason I'm doing the update today, this is the sector I threw out as a potential short, a lot of these individual brokers, we went down to now, that's a pretty good support level, and we're starting to crack it. 76.57, here's what it looks like on the daily chart. You can see it nice and clean there. What I mean by that, distinct reaction, 2, 3, a couple reactions through there, and then it was support, clean reaction there, another clean reaction, and boom, breakdown candle today. Must have had earnings or something. It's down 10.5%, and my targets are down here, 67, 77, and then ultimately at least this uptrend line. But it just shows you, hey, this is usually a red flag for the entire markets when the financial sector, especially in a rising rate environment for the banks, more so the banks, but also the broker dealers. They're making a lot of money in a bull market because everybody and their brothers trading and doing the online thing and buying speculative trades in AMC and GameStop, and so during especially the latter stages of the bull market, there's a lot of revenue these guys are seeing. And when things slow down, it's been say what you want about the markets. Maybe I'm going to be wrong on where it's going, but say what you want about it. But the S&P 500 today is trading where it was. If I grab this, turn off all the lines, back here, and that was 9 months ago. You have the NASDAQ 100, the tech-heavy index. where most people are playing, Apple and Facebook, Amazon, Tesla, those big overweight in those. We're trading where we were 1.2 years ago. So what happens is people start to get frustrated and throw in the towel. Maybe they've lost a lot of money buying dips, or just getting frustrated where at. So you can see this is to me, it seems like a slow roll, and that's often how the economy turns. Especially, it's not like a speedboat. It's more like a airline carrier, or I'm sorry, aircraft carrier, or a super tanker out in the ocean. They take a slow roll. So that's what's going on there. And of course, the Nasdaq 100 gives you a better insight to the growth sector, growth stocks. That's what it's overweighted towards compared to S&P 500, which is held up better because it has defensive issues, and we've seen a lot of money running into defensive issues. But I am seeing, and I didn't mean to cover this, but I will right now. I'm seeing a lot of defensive issue names like. Here, let me go here, turn on the lines. Costco, big divergent high. It's been one of the strong ones holding up the indexes, starting to crack right there. Who else did I see? Pepsi. When I go down the line, a lot of these defensive sector companies are starting to break down as well. And so, this will be the final pillar of the market, I think, when you see financials and defensive stocks, which have had a pretty big run up. Institutions have been moving into those, but from my experience, they go down. They just tend to fall less than the overall market than high growth companies. But during a bear market, especially, they will drop. Just about everything drops, other than risk off assets, treasury bonds, and at times gold. It all depends. Let me go back to the brokers real quick. I don't want to spend too much time there, but just kind of show you that I'm seeing some breaking down. I'll just stick to the weekly charts so the big picture is more clear. There's Morgan Stanley, big wedge pattern, divergent high right there. That was our last marginal divergent high. Boom, and big support level. So many stocks and sectors I'm seeing this where they topped out. They traded for anywhere from several months to up to a year or more, just like the Nasdaq or Russell 2000, which I intended to get to, and I will. Breakdown backtest. It's pretty thin. There's just not a lot of support until down here. And so if somebody put a gun to my head and said you got to go long or short Morgan Stanley for a year, but you could set your stop buy to cover orders or whatever, I'd set it right here. I'd short this one and game a bet that it's going to drop another 34% on top of the 25% that it's already fallen. That's my target, 57.44. It comes in there. There's a trend line that comes in around there as well. And I could go down the whole lot. Goldman Sachs, they're all falling. A few, I should say, not all, mostly some. Raymond James hasn't broken down yet, but looks poised to, and so forth and so on. Market access, this one's just taken on the chin. Here's a great example of just a beautiful clean trend line. It goes back to it's the bull market trend line, and this is what I'm seeing one by one. These market leaders are starting to break. Apple hasn't broken down its long-term trend yet, but when it does, here's what you have. There's Apple on the weekly chart. Load the lines. And this is where it's going to most likely go to. I have a trend line coming back here from about early '09. A lot of reactions, divergent high, and I've covered it many times in the past. These divergent highs typically result in double-digit corrections, and it just needs a break. We're in a little price channel right here. Boom. Once Apple breaks, that is the leader. That is the 800-pound gorilla in the room right there. Biggest company in the world, largest component of the S&P 500, largest component of the Nasdaq 100, and it's also held up. So when it breaks, the rest of them will most likely go down. But that's the thing, and I've covered this for months now. More and more stocks have already broken down. The market's been going down, and when I've covered charts in recent months, the percentage of stocks trading above or below their 200-day moving averages, 50-day moving averages. So we've seen the market breadth deterioration for a while. It's been a slow roll, but we continue to roll, is my point. And all right, let's get off the markets. I already covered bonds. I touched on the broker dealers. Told you I still think that's an opportunity there. Financials as a whole, but I have a sweet spot for the broker dealer stocks. Home builders, of course, I mentioned that as a a bearish sector, one that you could short. You can use ITB. XHB is the other home builder ETF. Remember, they also have Lowe's and Home Depot, but that doesn't matter because those guys are falling too. This is a weekly chart. You can see they, like everything, put in these big divergent highs late last year in most cases, like ITB, and has been moving lower. Took out this uptrend line right there, and continues to fall. And just recently took out this 58, 53-ish support, and is headed towards most likely my next target around 51.66. Home Depot, boom. Lowe's, boom, breakdown as well. Not just the fact they're falling, but they're breaking support. They're breaking key moving averages. So again, this is why, and I know I'm spending a lot of covering, saying a lot, the same thing over and over, but in different stocks and different sectors. And what I'm trying to do to you, and more so myself, is to justify, okay, why do I not believe those 60-minute divergences that I pointed out that are still intact right now? Why do I think they're likely to fail, even if we get a little bounce? And it's because of all this. There's a nice bear flag on Sherwin-Williams SHW, and there's the flagpole, little flagging action. And if that flag plays out, it's going to it measures all the way down there. There's add the flagpole onto the top of the flag, and that gives you your measured targets. So yeah, just ugly looking charts, pretty looking charts if you're bearish and short, and you can ride out all the counter trend rips and dips. There's your next target on DR Horton, which is DHI ticker symbol. I don't see any support here. It broke that last support there at 82.34, and it's been falling. So got a little more downside to go. All right, now I could go through them all. Lennar is coming up on support. That is a target. So you can tactically cover, if you're doing a basket of these, that's what I mentioned is the best way. Right now you might want to be underweighted Lennar, taking some profits, or trail your stops, when you get to a target, because we could break that support and it could go on down to the next level. What's next? Semis, the other sector that I threw out there as a trade idea recently, one of the most bearish is semis. SOXX tracks this Phillips Sox Semiconductor Index, and big divergent high here on the weekly chart, been moving lower. First support has now been taken out. I gave you this chart recently. S1, meaning first support level, is about 435.83 right there. It was resistance right here, then you broke out, and it was then support. Then we had another move up here. We did that just like a lot of indexes and sectors. We had a breakout to new highs, but then we went sideways for a while and failed those breakouts with an impulsive move down, set us up in the next trading range, and now we're cracking below there, which should open the door soon to my first target there, T1, and then ultimately T2. So I still maintain these targets, and that's a lot of meat on the bone. I forget where more recently. I've thrown this out on and off in the past, long and short, but most recently would have been somewhere in here. Let's just say from this level, when S1 goes, which is now gone, so the sell signal is intact, that's about a 12% drop to that first target and about a 38% drop to the next target. And I also said you could trade SOXS if you want the juice. It's just the 3-time leverage. It must have had a reverse split. It did. That's why my lines are now all shifted. So I had targets for you before, and they're gone. That's a limitation of this charting platform. They don't make adjustments on the trend lines. So I have to recreate the chart every time. But either way, still looking good. And finally, just a quick update on crude oil for those trading crude. That is, on the Junes now. The Mays are going to stop trading soon. That was the chart I gave you before with the Mays. I need to mark it up for the Junes. You have that big trend line there. You had that divergent low. Breakout right there, and it's been moving up, but here's your trend lines. Let me see how much I've marked up already. I started marking this one up today. Let me go back to the June contract. That's if you're going to open a position now, or you need to roll the Mays into the June soon. There it is, downtrend line, bullish falling wedge. This is just a 1 month hourly chart right here, 1 hour candlesticks. There's your trend line right there. And this, we've been diverging. You have divergence now on both the RSI and PPO. So boom, just need to crack this trend line, and a minor support there about 106.30. break that, we're probably going to get a pullback. So anyways, I think this breakout from this 60-minute bullish falling wedge has most likely run its course now or close to it, and will trigger a sell signal there. And uh, haven't marked targets yet, but you can look at some of these reaction lows, just target those or trail it down for a while. All right, that's about it. So to summarize, I'm looking at the clock. No matter what, I'm not going to get the video out to you guys before the close, but it doesn't matter. Today was kind of a go nowhere day, so there was not much to update. Right now, we're about to close, and this is the Nasdaq 100 futures. We're down 0.05%, so we're virtually flat. And so that is it. That's a big level. To just summarize, we are still above support with bullish divergences in place, and they still may play out, despite the fact I think that they do. This is big resistance right here. I'd really be, I'd start to be concerned if we popped much over that 14,294 level, because we have a lot of reactions there. But you remember, we still got rejected off the 200 days here. So as long as we're below the 200 days from big picture, to me, it's a short the rips kind of environment, especially for less active traders, trend traders. I wouldn't be overly concerned if, but near term, like I said, I'd like to see any bounce ideally contained here at that 14,294. And again, certainly want to see the recent lows get taken out. At that point, I would be interested in adding some short exposure. Right now, would not add because we're right at or a hair above. We've been holding support with positive divergences in place. So that's that. All right, guys, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.